At 9:31 a.m. Eastern Time, the opening bell rang. 90 seconds later, the illusion collapsed. The Dow Jones plunged hundreds of points before traders finished their first sip of coffee. The S&P 500 dropped more than 3% almost instantly. The Nasdaq fell even harder, tech stocks sliding in synchronized freefall. Screens across lower Manhattan turned red. By mid-morning, over $340 billion in market value had evaporated. This was not a routine correction, not profit-taking, not algorithmic noise. This was shock, and the trigger had been pulled 3 hours earlier. At 6 a.m., Canada announced what it called an emergency resource allocation framework. The language sounded bureaucratic. The impact was surgical. Effective immediately, Canadian exports of crude oil, natural gas, electricity, uranium, potash, and rare earth minerals would be prioritized according to trade alignment status. Countries maintaining tariff-free trade would receive Tier 1 priority, guaranteed supply contracts, stabilized pricing, predictable allocation. Countries imposing tariffs on Canadian goods would fall into Tier 2. The United States was explicitly named. Tier 2 did not mean a cutoff that would violate agreements. Tier 2 meant uncertainty, restricted allocation, market-based pricing without preferential guarantees. Monthly review tied directly to tariff policy decisions in Washington. In plain terms, if a refinery in Texas and a refinery in Rotterdam both bid for Canadian heavy crude, Rotterdam would move to the front of the line.
We have
If
a
an
critical
American
drop in the Gulf
utility
supply line.
and a Japanese
That's cutting it
energy
close.
firm both required long-term natural gas supply, Japan would receive allocation priority. If a U.S. semiconductor manufacturer and a South Korean competitor sought rare earth materials, the South Korean firm would secure first access. The United States would still buy, but it would wait, and it would pay more. Wall Street understood instantly what that meant. Midwestern refineries are engineered around Canadian heavy crude. Substitution is not seamless. Venezuelan supply is unstable. Middle Eastern grades require different refining configurations. Margins compress when feedstock changes, energy stocks were hit first. Major integrated producers dropped sharply. Refining heavy firms fell even more. Analysts recalculated margin projections in real time. If input costs rise and supply reliability falls, earnings guidance collapses. Utilities followed. States in the Northeast and Midwest import Canadian electricity during peak demand. If allocation priority shifts, those utilities must buy on volatile spot markets or activate less efficient generation. That translates into higher consumer rates or regulatory backlash, then technology. Rare earth minerals underpin electric vehicles, semiconductors, smartphones, wind turbines. Canada is not the only supplier globally, but it is a politically stable one. Remove guaranteed priority and American firms face price competition from Europe and Asia that did not exist before. Agriculture was next. Canadian potash is a cornerstone input for American fertilizer production. Restrict priority access in the months leading to planting season and farmers face tighter margins, lower yields, and higher food price volatility. The sell-off broadened because investors recognized a pattern. This was not a symbolic retaliation. It was structural leverage applied at the input layer of the U.S. economy, market price forward risk. And forward risk had just been recalibrated. Credit default swaps widened across energy, utilities, and industrial sectors. That is not retail panic. That is institutional insurance against potential corporate stress. Options markets exploded with long-dated put contracts, signaling that traders were hedging not for a 2-day bounce, but for a quarter-long or year-long slowdown. Capital began to move. Foreign investment flows shifted out of U.S. equities within hours. Canadian markets rose modestly as American indices sank. Currency traders marked down the U.S. dollar while the Canadian dollar strengthened. For years, Washington operated under a central assumption: access to the American market is the ultimate leverage tool. That assumption framed tariff strategy. Pressure trading partners until they concede because they need U.S. consumers more than the U.S. needs their exports. The morning's trading session suggested a flaw in that logic. The United States imports critical inputs from Canada that cannot be replaced overnight: energy, minerals, electricity, fertilizer components. These are not luxury goods, they are industrial foundations. Canada's counter strategy was simple. Do not block, do not violate agreements, reorder priority. In doing so, Canada signaled that it could redirect exports to alternative markets willing to trade without punitive tariffs: Europe, Japan, South Korea, other partners hungry for stable supply. The message embedded in the policy was unmistakable. Tariffs have consequences beyond symbolic retaliation. Investors do not wait for speeches to end before acting. They react to structural shifts, and this was structural. By midday, the panic had evolved into repricing. Trading floors were no longer reacting to headlines, they were recalculating earnings models. Analysts revised cash flow forecasts under new input cost assumptions.
Hold on, the Dow is
If
stabilizing.
Canadian
Check
crude
the volume.
moves to non-US buyers first, American refiners must compete harder and pay more. If Canadian natural gas contracts become less predictable, utilities hedge at higher
As you can
premiums.
see, the systemic risk
If
correlation
rare
is
earth
spiking
allocations
right here. If we
tilt
run the
toward
Monte Carlo
Asian
simulation
manufacturers,
It's recalculating
American
now.
tech
The
firms
exposure
lose
levels
supply
have shifted.
certainty
Yeah.
that underpins production schedules. Uncertainty is expensive. Markets do not merely punish loss. They punish unpredictability, and Canada's framework introduced a variable Washington could not immediately neutralize. Tier status reviewed monthly, linked directly to tariff policy. That clause was not accidental, it was a lever with a visible handle.
You are not hearing me.
If
The
tariffs
situation on the
remain,
ground is
allocation
deteriorating
pressure
faster than we
remains.
anticipated.
If
We need
tariffs
federal
are
assistance
lifted,
by midnight,
priority
or I'm going
restores.
public.
The conditionality was clean, which meant Wall Street understood something else just as quickly. This crisis was policy-driven, not cyclical, not pandemic-induced, not credit bubble fallout. It was a geopolitical response to trade escalation. That distinction matters because cyclical downturns recover through stimulus and monetary easing. Policy conflicts require political reversal, and reversal requires concession. Inside Washington, calls began immediately: energy executives, agricultural lobbies, semiconductor manufacturers, governors from manufacturing states, all confronting the same reality. The United States could not compel Canada to sell under preferred conditions. You can tariff imports. You cannot force a supplier to prioritize you. Canada did not cut exports, it restructured preference. The brilliance of the move was legal insulation, no treaty violation, no embargo, no explicit discrimination prohibited under trade law. Allocation frameworks are common in energy markets. Pricing adjustments are market-based, but priority access is power. Wall Street's deeper fear was not today's $340 billion of aberration, it was the signal embedded beneath it. If Canada is willing to use resource allocation as leverage once, it can do so again. And if other trade partners observe its effectiveness, they may adopt similar mechanisms. That is how confidence erodes. Confidence in predictability, confidence in American leverage, confidence in the assumption that market access alone guarantees strategic dominance. Energy dependence is asymmetric. The United States is a major producer, but regional infrastructure binds it to Canadian supply chains.
Get me 50 million
Refineries
CAD.
in the Midwest are optimized for Canadian heavy crude. Pipelines like Keystone and Enbridge networks exist for a reason. Electrical interconnections tie grids together across borders. Unraveling those dependencies takes years and billions in capital. Markets know that, which is why the sell-off was broad, not isolated. When credit spreads widen across multiple
As you can see, the
sectors
shortage is critical.
simultaneously,
We only have 3 weeks
it
of
signals
supply left.
systemic repricing.
What are the immediate implications
Investors are
for
no
the
longer
spring planting
evaluating
schedule?
individual companies. They are assessing national policy risk. The dollar's weakness added another layer. Currency markets reflect macro confidence. A sliding dollar implies capital seeking relative safety elsewhere. Meanwhile, the Toronto market edged higher, not dramatically, not euphorically. Just enough to indicate comparative stability that contrasts stung. Because the narrative underpinning tariff escalation was American resilience versus foreign fragility. The morning's data inverted that storyline. Canada's economy would feel pressure too. Redirecting export is not frictionless. Transportation routes shift, contracts renegotiate. Short-term revenue volatility occurs, but markets concluded that Canada's pain would be manageable. American corporations, however, faced immediate cost uncertainty layered on top of existing inflation and interest rate pressures. The humiliation was not theatrical, it was arithmetic. Trump's strategy relied on the premise that partners would yield quickly under economic stress. Instead, one partner engineered stress into American supply chains without crossing legal red lines. And Wall Street reacted not to politics, but to exposure. Exposure to energy volatility, exposure to mineral scarcity risk, exposure to agricultural input shocks. The broader implication loomed larger than the single trading session. If tariffs remain and allocation priority stays tiered, companies must adjust long-term procurement strategies. They may diversify away from North American integration. They may seek alternate suppliers at higher cost. They may pass those costs to consumers. Higher consumer prices feed inflation. Inflation complicates monetary policy. Higher rates slow investment, a chain reaction. Investors began modeling that chain. This is why the sell-off felt different from routine volatility. It was not momentum trading, it was structural reassessment. The White House faced limited options: escalate and risk deeper supply constraints, capitulate and signal strategic retreat, attempt negotiation from a weakened posture. None offered immediate relief, and markets abhor policy paralysis. The deeper lesson unfolding beneath ticker symbols is this: in a globally integrated economy, leverage cuts both ways. Resource exporters possess quiet power. Allocation, timing, and pricing become strategic instruments. Canada demonstrated that reality with a 6-M directive. Wall Street delivered its verdict 3 hours later. $340 billion erased before lunch. Not because investors dislike volatility, but because they recognize when a trade war evolves into a supply war, and supply wars are not one with rhetoric. They are one with resources. Canada used it. The market made clear which side absorbed the shock.